Welcome to my class. Today we're going to discuss the Management Reporting System. The Management Reporting System. Management reporting is often called discretionary reporting because it is not mandated as is financial reporting. So management reporting is furnishing relevant information to management by means of reports constantly. So MRS directs management's attention to problems on a timely basis. So one of the essentials of a good reporting system is promptness. So there is a need that management reports should be provided on time to the management. Why? Because it helps the management take good business decisions, in as much as it helps identify the problem, evaluate alternate solutions, implement the best solution, and review implementation. Next, MRS promotes effective management. It is because MRS helps capture data needed by managers to run the business effectively. And with MRS, the business is able to check its performance, its effectivity, and also its efficiency. Another is MRS supports the organization's business objectives. Primary object of management reporting is to obtain information about the operating results of the organization regularly in order to use them for further planning and control. And this is geared toward the organization's business objectives. So, our management reports should be patterned to the business goals, especially that we are checking the performance of the company. So, an effective management reporting system helps in decision making, in management effectiveness, and responsiveness to issues, and in the efficiency of resources. Designing an effective MRS requires an understanding of the information that managers need to deal with the problems they face. And now let's discuss one by one the factors that influence MRS, namely management principles, management function, level and decision type, problem structure, types of management reports, responsibility accounting, and behavioral considerations. For the first factor, management principles. Management principles provide insight into management information needs. So, among the management principles, let's name it: formalization of tasks, responsibility and authority, span of control, and management by exception. First, formalization of tasks. It suggests that management should structure the firm around the tasks it performs rather than around individuals with unique skills. Under this principle, organizational areas are subdivided into tasks that represent full-time job positions and have clearly defined limits of responsibility. So, in a company, it is very important to define and align the key responsibility areas. So, for the acronym, we have this KRA. So, define the duties and responsibilities. If there are side duties, it is important to mention some of the side duties, and the general as required and as needed by the management. So, implication for MRS. Formalizing the tasks of the firm allow formal specification of the information needed to support the task. When you prepare the duties and responsibilities, you will not prepare it based on the current person or employee assigned. You have to define the duties and responsibilities based on the position. Thus, when a personnel change occurs, the information the new employee will need is essentially the same as for his or her predecessor. So, what are the tasks of the outgoing employee are the same tasks the incoming employee should perform. So, that's for formalization of tasks. Next is responsibility and authority. So the principle of responsibility refers to an individual's obligation to achieve desired results. So responsibility is closely related to the principle of authority. So if a manager delegates responsibility to his subordinate, he or she must also grant the subordinate the authority to make decisions within the limits of that responsibility. So, in a business organization, managers delegate responsibility and authority downward through the organizational hierarchy or structure, meaning from superior to subordinates. So, implication for MRS. So, the principles of responsibility and authority define the vertical reporting channels of the firm through which information flows. So, it is a vertical information flow. So, managers at lower levels receive information that is more detailed than the highest. Normally, the president or general manager usually require more summarized information. The third principle is span of control. So it refers to the number of subordinates directly under his or her control. So the size of the span has an impact on the organization's physical structure. So, a firm with a narrow span of control has fewer subordinates reporting directly to managers. Then, firms with broad spans of control or more subordinates reporting to each manager tend to have wider structures with fewer levels of management. So, implication for MRS. Managers with narrow spans of control are closely involved with the details of the operation and with specific decisions, while broad spans of control remove managers from these details. So, organizational behavior research suggests that wider span of control is preferable because it allows more employee autonomy in decision making. Thus, this translates into better employee morale and increased motivation. But it depends on the nature of the task, because the more routine and structured the task, the more subordinates one manager can control. Next is, and the last principle is management by exception. So, the principle of management by exception suggests that managers should limit their attention to potential problem areas, that is, exceptions, rather than being involved with every activity or decision. So, this means managers maintain control without being overwhelmed by the details. Implication for MRS. managers need information that identifies operations or resources at risk of going out of control. So the report should support management by exception by focusing on changes in key factors that are symptomatic of potential problems. Providing managers with unnecessary details may draw them away from the important facts, and these unnecessary details must be excluded from the reports. The second factor that influences MRS is the management function level and decision type. So the management functions of planning and control have a profound effect on the MRS. Here, the planning function is concerned with making decisions about the future activities of the organization, while the control function ensures that the activities of the firm conform the plan. This entails evaluating the operational process against a predetermined standard and, when necessary, taking corrective action. Let's discuss the 4 categories of planning and control decisions. So, to name them, we have strategic planning decisions, the tactical planning decisions, the management control decisions, and the operational control decisions. So, to start with, strategic planning decisions. Here, top-level managers make strategic planning decisions, including setting the goals and objectives of the firm, determining the scope of the business activities such as desired market share, markets the firm wishes to enter or abandon, the addition of new product lines, and the termination of old ones, and merger and acquisition decisions. Another is determining or modifying the organization structure and setting the management philosophy. So strategic planning decisions have the following characteristics. So first, they have long-term time frames. Because they deal with the future, managers make strategic decisions that require information supporting forecasting. Next, they require highly summarized information. Strategic decisions focus on general trends rather than detailed activities. Next, they tend to be non-recurring, which means these are usually one-time events. Also, strategic decisions are associated with a high degree of uncertainty. The decision maker must rely on insight and intuition. So, judgment is often central to the success of the decision. Next, they are broad in scope and have a profound impact on the firm. So once the strategic decision is made, it permanently affects all the levels of the organization. And last, strategic decisions require external as well as internal sources of information. So that's for strategic planning decisions. Tactical planning decisions. These decisions are subordinate to strategic decisions and are made by middle management. So the characteristics of tactical planning decisions are shorter term, more specific, recurring, have more certain outcomes, have a lesser impact on the firm than strategic decisions. So let's say I'm the manager of the manufacturing firm. My target is to have an increased sales and production by 100,000 units this year compared to last year. So, the production manager would likely have a tactical decision of setting the monthly production schedule in order to achieve the goal of an increased production of 100,000 units more than last year. So, that's an example of a tactical planning decision. Next, for management control decisions. So management control involves motivating managers in all functional areas to use resources, including materials, personnel, and financial assets, as productively as possible. So you have these standards when your subordinate was unable to meet that standards. So you as the manager may take corrective action on that particular subordinate, or rather, you will find the causes why the subordinate wasn't able to meet that standard. But when your subordinate meets or exceeds your expectations, of course, take note, you will not sacrifice the quality of your product or services. The subordinate may be rewarded. So that's an example for management control decisions. Operational control decisions. So operational control ensures that the firm operates in accordance with the pre-established criteria. Operations managers exercise operational control. So the characteristics are: it is narrower and more focused than tactical decisions because they are concerned with the routine tasks of operations. Next is, it is more structured than management control decisions. It is more dependent on details than planning decisions, and it has a shorter time frame than tactical or strategic decisions. So we have the three basic elements of operational control decisions. These are setting standards, evaluating performance, and taking corrective action. The first basic element of operational control decision are standards. Standards are pre-established levels of performance that managers believe are attainable. So standards apply to all aspects of operations such as sales volume, quality control over production, cost for inventory items, material usage in the production of products, and labor cost in production. So once established, these standards become the basis for evaluating performance. So let's say I'm the manager of the manufacturing firm and I assigned my production manager to target a 10,000 units production per month. So the production manager will do his best, coordinate with his team that the manager wanted to have a target production which will be your standard production for the month, but then to realize at the end of the month that you only achieve half of the standard. So what are the possible causes of non-meeting the standard production as required by the manager, your general manager? So it may be caused by the machineries or equipments, it may be caused by the raw materials, or it may be caused by the personnel. So that is an example for standards. Next is performance evaluation. So the decision maker compares the performance of the operation in question against the standard. So the difference between the two is the variance. Let's say a price variance for an inventory item or a raw material. So we have this expected price, which is your standard price, and we have this price actually paid. So if your actual price is greater than the standard, that results to unfavorable price variance. Why? Because it will contribute to a higher product per unit cost. But if the actual price is less than the standard, the variance is favorable. So for the third element, we have taking corrective action. So after comparing the performance to the standard, the manager takes action to remedy any out of control condition. however, that we must apply extreme caution when taking corrective action. An inappropriate response to performance measures may have undesirable results. So, with reference to example number 2, to achieve a favorable price variance, your purchaser would prefer to buy from the low price vendors in order to save money and contribute to cost cutting. But with that move of the purchaser, he may be sacrificing the quality of the outputs. So if the lower quality raw materials result in excessive quantities being used in production and your waste is higher than the normal, of course, the company will experience an unfavorable material usage variance. So that unfavorable material usage variance will completely offset the favorable price variance, and it will result to an unfavorable total variance. So if we link the examples, the result of number 3 example would correlate to our sample number 1. So that may be one of the possible causes why the production department wasn't able to meet the standard production of 10,000 units per month but dropped down to half of the production. So that is all about the operational control decisions. As presented here, we have the classification of decision types by decision characteristics. So we have the decision characteristic column, then the strategic planning, tactical planning, management control, and operational control. So as you see for the time frame, strategic planning is long term, tactical planning is medium term, management medium term, while operational control is short term. As to scope, strategic planning has a high impact. Tactical planning has a medium impact, while management control and operational control have the low impacts, where operational control is the lowest. As to level of details, strategic planning is highly summarized, while tactical planning is detailed. Management control may be moderately summarized, while operational control is highly detailed. As to recurrence, strategic planning is non-recurring, tactical planning is periodic recurring, also for management control, while operational control is frequent recurring. As to certainty, strategic planning and management control are uncertain, while tactical planning and operational control are highly certain. So the third factor that influences MRS is the problem structure. So the structure of the problem reflects how well the decision maker understands the problem. A structure has 3 elements: the data, which is the values used to represent factors that are relevant to the problem. Second is the procedures, which are the sequence of steps or decision rules used in solving the problem. And third, objectives, which are the results the decision maker desires to attain by solving the problem. So for the structured problem, when all the 3 elements data, procedures, and objectives are known with certainty, the problem is structured. So structured problems do not present unique situations to the decision maker, and because their information requirements can be anticipated, they are well suited for traditional data processing techniques. So in effect, the designer who specifies the procedures and codes the program solve the problem. Example of a structured problem is payroll calculation. So for the data, we can identify it with certainty. So we have the hours worked, hourly rate, withholdings, tax rate, and so on for the payroll. Next, the procedures are also known with certainty. So to compute the gross pay, you have hours worked times pay rate. And for the net pay, so we have the gross pay minus taxes minus withholdings and any other deductions. And the third objective of payroll is to discharge the firm's financial obligation to its employees. So for the unstructured problem, it is when any of the three characteristics identified previously are not known with certainty. So in other words, an unstructured problem is one for which we have no precise solution techniques. Either the data requirements are uncertain, or the procedures are not specified, or the solution objectives have not been fully developed. So such a problem is normally complex and engages the decision maker in a unique situation. So even the systems analyst cannot fully anticipate user information needs, rendering traditional data processing techniques ineffective. So that's for the problem structure. The fourth factor that influence MRS are the types of management reports. So reports are the formal vehicles for conveying information to managers, and reports tend to imply a written message presented on sheets of paper. Well, we can express a report either verbally, in numerical form, in graphs or charts, or a combination of those. And our management reports may be on sheets of paper or any digital image. So for the report objectives, recall that information leads the user to an action, and a report should have information content for it to be useful, and their value is the effect that they have on users. So reports have two general objectives. The first is to reduce the level of uncertainty associated with the problem facing the decision maker, and the second is to influence the decision maker's behavior in a positive way. So if the reports fail to accomplish these two objectives, therefore your report lacks information content and is of no value. So a report to be effective, it should have these report attributes. So we have relevance, summarization, exception orientation, accuracy, completeness, timeliness, and conciseness. So for relevance, this means that each element of the information in your report must support the manager's decision. So as much as possible, information must be necessary details. Next is summarization. So report should be summarized according to the level of the manager. So in the organizational hierarchy, we are going to report to the CEO or the general manager. So your report must be in a summarized format. But if the report is for the lower level management, the report must be more detailed. For exception orientation, control reports should identify activities that are at risk of going out of control and should ignore activities that are under control. So So example, the purchaser with ordering responsibility of 10,000 different inventoriable items. So he would report as part of his exception-oriented report, he would only identify those inventory items that had fallen to their reorder levels, and from there he could easily prepare purchase orders. So no need to enumerate all the inventories. You pick up those who are now at their reorder points. So for accuracy, so no question for reporting, accuracy is really a must. So information in reports must be free of material errors, because a material error may cause a wrong decision or a failure. Next is completeness. So information, of course, must be complete as possible. Ensure that the essential information should not be missing in the report. So that's for completeness. Next is for timeliness. Of course, management reports, since these are required by manager, and these are needed by managers to address issues and concerns in a particular area or to the organization as a whole, it should be provided on time. So, timely information that is sufficiently complete and accurate is more valuable than the information that is so perfect but it arrived too late and the harm has been done to the company. So MRS must provide managers with timely information. Next is conciseness. So reports should be presented concisely. If you have coding schemes, you can use it on your report as long as it should clearly present the data you want to convey in your report. So that's for the report attributes. And now we're gonna discuss the two subclasses or the two types of management reports, which are the program reports and the ad hoc reports. So program reporting. Programmed reports provide information to solve problems that users have anticipated. So two subclasses of program reports. We have scheduled reports that are produced according to an established time frame and could be daily, weekly, quarterly, and so on, while on-demand reports are triggered by events, not by the passage of time. So as per illustration, we have the types of report and classified as to scheduled and on-demand. So for planning reports, the financial budget, sales forecast reports, and projected cash flow reports are considered scheduled reports, while materials requirement reports and production schedules are on-demand. For the control reports, the cost center reports, profit center reports, profitability by line of product, labor distribution reports, and equipment utilization reports are considered scheduled, while quality control reports and inventory exception reports are on demand. So, generally, looking at the illustration, what are classified as scheduled or on demand, you can see on the on demand column, the reports are mostly related to production. So more on the, although the other are operational, but it focuses on the production processes, the production reports. Next, for the ad hoc reporting. So ad hoc reporting is a business intelligence process used to quickly create reports on as needed basis. So ad hoc reports are generally created for one-time use to find the answer to specific business question. So managers with limited computer background preferably prepares ad hoc reports. So data mining is a concept of data resource tapped to support ad hoc reporting needs. So data mining is the process of selecting, exploring, and modeling large amounts of data to uncover relationships and global patterns that exist in large databases but are hidden among the vast amount of facts. So this involves sophisticated techniques such as database queries and artificial intelligence that model real-world phenomena from data collected from a variety of resources, including transaction processing system, customer history databases, and demographics data from external sources such as credit bureaus. So two general approaches of data mining are verification model, which uses a drill down technique to either verify or reject a user's hypothesis, and the discovery model that uses data mining to discover previously unknown but important information that is hidden within the data. So this model employs inductive learning to infer information from detailed data, by searching for recurring patterns, trends, and generalizations. So this approach is fundamentally different from the verification model in that the data are searched with no specific hypothesis driving the process. So the fifth factor that influences MRS is responsibility accounting. So for the meaning and definitions. Responsibility accounting is a system of management accounting under which accountability is established according to the responsibility delegated to various levels of management, and a management information and reporting system instituted to give adequate feedback in terms of the delegated responsibility. So under this system, divisions or units of an organization under a specific authority in a person are developed as responsibility centers and evaluated individually for their performance. Hornby defines responsibility accounting as a system of accounting that recognizes various responsibility centers throughout the organization and reflects the plans and actions of each of these centers by assigning particular revenues and costs to the one having the pertinent responsibility. It is also called profitability accounting and activity accounting. So according to this definition, the organization is divided into various responsibility centers, and each center is responsible for its cost. The performance of each responsibility center is regularly measured. So the concept of responsibility accounting is that it is used to measure performance of divisions of an organization rather than the organization as a whole. So it is a system of control where responsibility is assigned for the control of cost, and there are persons made responsible for its control. Proper authority is given to the person so that they are able to keep up their performance, and in case the performance is not according to the predetermined standards, then the persons who are assigned this duty will be personally responsible for it. So in responsibility accounting, the emphasis is on men rather than on systems. Responsibility accounting collects and reports planned and actual accounting information about the inputs and outputs of responsibility centers. Responsibility accounting must be designed to suit the existing structure of the organization. Responsibility should be coupled with authority. An organization structure with clear assignment of authorities and responsibilities should exist for the successful functioning of the responsibility accounting system. The performance of each manager is evaluated in terms of such factors. Essential features of responsibility accounting. First, the inputs and outputs or cost and revenues. So the implementation and maintenance of responsibility accounting system is based upon information relating to inputs and outputs, which are expressed as cost and revenues respectively. Thus, responsibility accounting is based on cost and revenue information. Next, setting financial goals, the budget process. So the budget process helps management achieve its financial objectives by establishing measurable goals for each organizational segment. This mechanism conveys to the segment managers the standards that senior managers will use for measuring their performance. Budget information flows downward and becomes increasingly detailed as it moves to lower levels of management. Effective responsibility accounting requires both planned and actual financial information. So, this is what we call budget. It is not only the historical cost and revenue data but also the planned future data, which is essential for the implementation of responsibility accounting system. Responsibility centers. So the whole concept of responsibility accounting is focused around identification of responsibility centers. So these responsibility centers represent the sphere of authority or decision points in an organization. A responsibility center is under the control of an individual who is responsible for the control of activities of that subunit of the organization. However, the general guideline is that the unit of the organization should be separable and identifiable for operating purposes and its performance measurement possible. So we have here the responsibility centers. We have cost centers, revenue centers, profit centers, and investment centers. So as the name of the responsibility center itself defines its meaning. So for cost centers, it is responsible for the cost management within budgetary limits. Revenue centers, of course, responsible for generating sales revenue. Profit centers is responsible for both cost control and revenue generation, while investment centers has the general authority to make decisions that profoundly affect the organization, specifically on investments. Relationship between organization structure and responsibility accounting system. A sound organization structures with clear-cut lines of authority. Responsibility relationships are a prerequisite for establishing successful responsibility accounting system. So for responsibility accounting system, it must be designed to suit the organization structure of the organization. It must be founded upon the existing authority responsibility relationships in the organization. So the responsibility accounting should parallel the organizational structure to provide financial information to evaluate actual results of each individual responsible for a function. Next is assigning costs to individuals and limiting their efforts to controllable costs. So after identifying responsibility centers and establishing authority responsibility relationships, responsibility accounting system involves assigning of costs and revenues to individuals. So only those costs and revenues over which an individual has a definite control can be assigned to him or her for evaluating performance. And last, measuring and reporting performance. So in order for a control system to be effective, the deviations from the plans must be reported at the earliest time possible so that corrective actions may be taken for the future. And these deviations are known only when the performance is reported. So responsibility accounting system is focused on performance reports, and it is also known as responsibility reports, prepared for each responsibility unit. So unlike authority, which flows from top to bottom, reports should be addressed to appropriate persons in respective responsibility centers. So this report should contain information in comparative form, budget versus actual, and details of variances should be given relating to the specific center. Then those variances that are uncontrollable at a particular responsibility center should also be mentioned separately in the report. So to be effective, report should be clear and simple. You may use diagrams, charts, illustrations, graphs, and tables to make them attractive and understandable. The last factor that influence MRS are behavioral considerations. So for goal congruence. Goal congruence is a situation in which people in multiple levels of an organization share the same goal. So a well thought out organizational design causes goal congruence and results in an organization being able to work together to accomplish a strategy. So a carefully structured MRS plays an important role in promoting and preserving goal congruence. On the other hand, a badly designed MRS can cause dysfunctional actions that are in opposition to the organization's objectives. So as individual managers, they must serve their own best interest so that they also serve the best interest of the organization. So for information overload, this occurs when a manager receives more information than he or she can assimilate. So this happens when designers of the reporting system do not properly consider the manager's organizational level and span of control. So for example, the information volume that would flow to the president if the reports were not properly summarized would be so detailed, and those details should have been provided to the lower level managers. So providing the president, for example, detailed reports, so it would quickly overload the president's decision-making process. So, as discussed on the report attributes, the report should be complete, accurate, timely, and concise. So, it is proper that report to president should be properly summarized. Inappropriate performance measures. So one purpose of the report is to stimulate behavior, and it should be consistent with the objectives of the organization. So when inappropriate performance measures are used, the report can have the opposite effect. So performance measures should consider all relevant aspects of a manager's responsibility. And in addition to these measures of general performance like ROI, management should measure trends in key variables such as sales, cost of goods sold, operating expenses, and asset levels. So, non-financial measures such as product leadership, personnel development, employee attitudes, and public responsibility may also be relevant in assessing management performance. So performance measures can be grouped into two basic types. So we have results, which are the outputs or outcomes such as competitiveness or financial performance, and the other one is the determinants, which are the inputs such as quality, flexibility, resource utilization, and innovation. So this suggests that performance measurement frameworks can be built around the concepts of results and determinants.